Welcome to the WakeCon show, where we discuss housing economics and the economic forces shaping our communities. This is powered by Professor Lending, which is a residential mortgage brokerage based in Wake Forest, North Carolina, hence Wake. Econ together makes WakeCon. I'm Jordan Steffaniak, host of the WakeCon show, and I'm president of Professor Lending, and I'm your mortgage professor and licensed loan originator. This is part 4 of a 5-part masterclass series on buying your first house. It's not just for people buying their first house, but anybody buying a house, because you don't buy a house very often. It's not something you do normally. You don't know all the ins and outs. There's a lot of stuff. You may have bought 6 houses. You didn't know these things. And this can help you strategize and help you make the best decision and help you save money and help you build wealth over time. So it's an important, super important thing to know these things. In this episode, this is number 4, we're talking about the hidden strategies most buyers never use or know. So this is great for everybody, whether you're a first-time home buyer or not. By the end of the video, you're going to know how to use seller credits to beat price reductions every time. You're going to know how to use mortgage insurance strategically. What? You can use mortgage insurance strategically? Yes, you can. It's amazing. The tax advantages of homeownership. Mortgage insurance is a dirty word for most buyers, but in the right hands, it's actually your secret weapon. Okay? So some cool stuff here. We're going to cover stuff you're not going to find anywhere else. Let's jump to it. Leveraging your buying power. Most don't realize the power of the seller credit. They think you just lower the sales price and that's going to be a win. No, instead of lowering the sales price, consider requesting a seller credit to either cover closing costs or buy down your interest rate. So let's look here at an example. You got all 3 of them. So this is surprise, surprise here, so you could see who wins. But let's just show you these comparisons. Baseline, let's use a credit plus the buy down. Let's use a price reduction. So in this one, $300,000 purchase price. In this one, $300,000 purchase price. In this one, we get a $10K off the purchase price of $290. No seller credit in the first one. You get a $10K seller credit here. You get nothing in that one. So effectively for the seller, these 2 options are the exact same because they're walking away with $290 either way. Your interest rate in that first one, 6.125, and the last one, 6.125. But in this one, we're using that $10,000 to buy down the interest rate. Let's look at what happens to the monthly payment. 1607 versus 1709 versus 1768. So you save like $60 if you reduce the price to $290,000. But if you use $10,000 instead to buy down your interest rate, you just saved $161. You saved an extra $100 a month by using that $10,000. That's $2,000 a year that you're saving by doing this if you do the $161 a month. Wow, math is cool. Never thought math would be cool. Here you are. Math is cool. Strategy is cool. Strategy is cooler. It's more important to be strategic. You need to have somebody who understands the strategy. You need to have an agent who understands this and a lender who understands this. They can get creative with you to make the most strategic offer. It's not just about interest rate. It's about someone who understands the whole financial picture. Super important. You can leverage your buying power by using seller credits. Very cool. You can offer a little bit more. Now, obviously, it has to appraise for that little bit more, because if you offer 310 and it only appraises for 300, then you're kind of, the way lending works, it's only going to be based on that 300, and so then you're kind of like stuck. Not stuck, but it's not going to work out as nicely as you thought. But you could do these things where you get extra money that way, and the seller gets the same amount. So it works for both parties. There are also rules about how much of a seller credit you can get. Conventional, less than 10% down is maximum 3% of the purchase price. FHA, USDA, 6%. VA, 6%. Conventional, once you go over 10%, now you can do 6%. Once you go over, I think it's 20%, now you can do 9%. So it's cool. And if you're doing non-QM stuff, DSCR type stuff, which if you're a first-time buyer, you're not. But once you amass some wealth, generational wealth from owning your first home, you're going to want to buy more properties to grow your wealth and your stability for your family and your future. If you buy investment properties, you're going to do DSCR because that's the best for investment properties. So we can explain all that stuff in other videos. Then you've got these other interested party contribution limits, seller credits. IPCs are seller credits. The lingo goes on forever in the mortgage industry. There's a million lingo terms. So sorry, P&I, principal and interest. Seller credit, IPC, interested party contribution. There's limits, DSCR 6%. Sorry to give you that aside, but that just whets your appetite to buy more homes because real estate is awesome. Now let's talk about the power of MI. No one's going to teach you this. You won't find this anywhere. No lender knows this. Why? Because they didn't work in MI like I did for 7 years. I worked in MI for 7 years, and most people think mortgage insurance is terrible, but it's awesome, and it can be your secret weapon. Not only is it awesome from the sense that it allows you to buy a house before you had 20% down, because if you didn't have mortgage insurance, a bunch of lenders aren't going to let you do that. They're going to say, nope, you're too risky. MI comes in to save the day, lets you actually buy a house. But it also can save you money. So let's show 4 different options here, side by side. You do 20% down with no MI, your payment's going to be $21.23, but you brought $70,000 to do that. Let's say you do 15% down with what's called lender paid MI. Now your payment's going to be an extra $100 a month, but you got to keep $1,800 basically in your pocket. The rate's the same. You had to pay a one-time mortgage insurance payment up front. Now but you get to keep $18,000 in your pocket. So maybe it's worth it. $100 a month to keep $18,000. It might be worth it. Or you could do borrow paid monthly. Now your payment's a little bit higher because it's $30 a month of MI, same rate, but again, $52,500 down. Could be worth it. But what about this one? Let's do 15% down. Let's put $8,500 of what we would put towards a down payment towards buying down the interest rate. Now the interest rate's 5.125. I've got that $30 a month mortgage insurance. I'm still keeping an extra $9,000 in my pocket, but my monthly payment is lower than with no mortgage insurance. Mind blown. Okay. It's all about strategy. There are ways to do this to save on your monthly payment or to save cash in your pocket or to do both. You just have to understand how to do it. People think mortgage insurance is super expensive. It's not. Okay. Now it is, if you have a 580 FICO, it's going to be expensive. I'm sorry. I don't have any way to solve for that. But if you've got a good credit score, especially if you're putting 15% down mortgage insurance, it's not going to be that expensive. This isn't a quote for you. This is just an average expected based on, standard credit score, 750 or whatever. But it's not that expensive, right? So there are lots of strategic ways to use mortgage insurance to save you money. It's amazing. You can go put that $18,000 in a money market and make more money per month than you'd be paying in $30 a month. Or you do the borrow paid monthly, and for 2 years your home appreciates, you refinance, you get rid of MI, you only paid for it for a year and a half, and you got to keep $18,000 in your pocket. It just makes sense, but you need somebody who knows how to do it. So talk to somebody like me who actually gets mortgage insurance, and he can save you some money. There's also tax benefits to owning your first home, to owning any home, right? You can do the mortgage interest deduction. Homeowners can deduct mortgage interest paid on mortgage loans up to $750,000. Now you have to itemize your taxes, right? If you do that. So you're not taking the standard deduction, you're doing an itemized. So you have to have actually enough deductions to be better than the standard deduction, which can be difficult for some people. But you have property tax deduction. You can deduct up to $10,000 in state and local taxes, including property taxes under current federal limits. This is based in 2026. So I'm not a CPA, I'm not a licensed CPA or anything like that. So just take these with a grain of salt, but this is the facts as of now. You also have a mortgage interest credit if you qualify. If you received a mortgage interest credit certificate from your state or local government, you can claim that as a direct tax credit. Cool. Capital gains exclusion. When selling a primary residence, homeowners may exclude up to $250,000 or $500,000 of capital gains from taxation if they've lived in their home for at least 2 of the last 5 years. People are worried about capital gains tax. No, don't be worried. You're going to be fine. Okay. Home office deduction if you're self-employed. Homeowners can deduct a portion of housing costs if they use a portion of their house exclusively for business. So if you use this office like this office, if it's your business office, you can write it off on your taxes. Cool. Save some more money. Amazing. You can't do that when you rent. Homeownership is amazing, and you've got to know these things. You don't have to know all the things. You just have to be vaguely familiar with them and work with somebody who knows them and works with them every single day and can give you the best advice. You need an expert, a trusted expert who knows everything, not everything, knows most of the stuff, knows mortgages, knows real estate, can help advise you. The smartest people in the room are the people who know that they don't know everything and that they have trusted resources for their expertise things. I got my painting guy who knows all about paint, who tells me what to do and how to paint. I've got my real estate agent person who knows all about the market in my area, who knows where the houses are appreciating, where the houses aren't, where the new roads coming in, where the new shopping centers coming in, so they know that this house is going to double in value over the next 5 years. I've got my CPA who knows all the tax stuff, who makes sure it gets me all the money back that I possibly can. I've got my lender guy who knows all the different rules and regulations and can help me strategize financially to take advantage of all these benefits of mortgage insurance, of seller credits, of all these things to make sure I'm getting the best financial picture. Because it's not just about who can give me this interest rate. Anybody can give you that interest rate. It's about someone who actually understands how to do the whole picture strategically. All right, cool. That's number 4 of number 5. If you haven't watched the others, go check them out. Super helpful, tons of information in just 10 to 15 minutes. I think they're awesome. So I think you probably think they're awesome too. So I appreciate you tuning in, and definitely check those out.